Right now, the world's largest asset manager just slammed the doors shut. If you're a founder or a CEO with capital sitting in the system, you need to listen. BlackRock have officially restricted withdrawals from their private credit funds. This isn't just a corporate hiccup, it's the first visible crack in a $4.5 trillion shadow economy that is currently repeating the darkest days of 2008. Traditional banking is regulated by the Fed and protected by the FDIC, but there is a parallel world called private credit. When companies need $300 million and banks say no because they are too risky, these companies turn to third parties like Blackstone, Blue Owl, or BlackRock. Here is the data that should terrify every founder. Over 40% of companies borrowing from these private lenders had negative cash flow when they took the loan. They were losing money every month and using high-interest debt just to stay alive. The domino effect is visible. We are already seeing subprime auto lenders like Tricolor and suppliers like First Brands declare bankruptcy. As Jamie Dimon says in the cockroach theory, seeing one cockroach generally means that there's more hiding in the shadows. This is bad news. This matters because your traditional bank is likely tied to this mess. The IMF warns that America and European banks hold $4.5 trillion in exposure to these hedge funds and private credit markets. If these private markets continue to fail, certain banks won't be able to absorb the losses. According to Moody's, the most exposed banks include Wells Fargo, Bank of America, PNC, Citigroup, and JP Morgan Chase. Why did the Fed say banks pass stress tests with flying colors in 2025? Because they eased the requirements. They made it easier to pass while knowingly ignoring the stress of hedge funds and private equity. The Fed assumed these investments were long-term and wouldn't be sold during distress. They were wrong. Clients are selling and the system is freezing. As a business person, you don't panic. You pivot. Use the ABB strategy, always be buying. FDIC only covers $250,000 per depositor. If you have more, diversify into different bank accounts. Market crashes and recessions create more millionaires than any other time because the financially savvy buy good investments at a discount. Look into broad market funds like VTI Total Stock Market, SPY S&P 500, or QQQ Nasdaq 100. There is no need to panic. Here is why you are built for this. You have the financial scar tissue from 2008 and survived. You know that market crashes have happened 25 times in the last century and they are the premier wealth building events for the financially savvy. You don't need a moonshot. You need a strategy. Wall Street is cracking, but your legacy doesn't have to. You're a founder. You know that wealth is built when others are panicking. Diversify your accounts, stick to the ABB strategy, and remember, the market is currently going on sale. If you found this breakdown valuable, share it with one fellow entrepreneur who needs to protect their capital. Stay savvy.